Okay, so here's our last graph that we had before we did the board clear. So this R star, remember, is our targeted interest rate. And like I mentioned at the end there, every day money demand is changing. You need more money, less money, whatever. It's going everywhere. It's bouncing up, it's bouncing down, so on and so forth. So what happens if it does, if it bounces up for some reason? You know, there's an increase in money demand one day to MD2. You'll notice that that starts putting pressure on the interest rate to rise, right? There would be this R2 up here. And that increase in money demand is, well, causing the interest rate to go up. Well, what if the Federal Reserve doesn't want the interest rate to go up, right? We always hear on the news, we always see these stories, right? Fed sets interest rate at blah, blah, blah. And I mentioned last video, they don't actually set it. They influence it. Well, if the Federal Reserve says, no, we want R star, that's the interest rate we want, but society is now operating at MD2, at money demand 2, the Federal Reserve can look at it and say, well, there is an ordered pair combination of R star if I wanted to keep it constant, just put a bar over it. If I wanted to keep it constant and this new money demand, how much money would we have to supply, you know, to some Q2 amount to keep R constant? Maybe it's, I don't know, 15 million. These are made up numbers. And if that's how much money they need to supply, they can release money from their vault into society and effectively shift the money supply curve. Now, whenever you see questions on the homework, you don't have to worry about keeping R constant unless the question explicitly tells you to. If it's like, hey, show me the impact on the interest rate of people needing more money, well, then you would show me money demand shifting, the interest rate going up. But sometimes, you know, so kind of watch the wording on those questions, and of course, always reach out via email if you have some unsure on the wording. But if they say something like, hey, the Fed wants to keep R constant, well, then that means that there's going to be a money supply shift or a money supply change as well. So I think the next question that we kind of want to start addressing is kind of maybe this how, you know, how can the Federal Reserve change the money supply? Because I think we would all have totally noticed it if there was just like, you know, God, what was it, Simpsons, Family Guy? I don't remember. It was one of those cartoons where a blimp floated over and was just throwing out money. We would all notice that. They don't do that. So how then is the Federal Reserve changing money supply? So to answer that, I thought we would kind of maybe look at the Federal Reserve in a little bit more detail and their methodology. So we are starting to blend in some of our other readings now. We're blending in a little of the Chapter 3 selection as well as the Chapter 12 selection that are on the outline. So just kind of keep that in mind. So how can the Federal Reserve change the money supply? I want to start with doing a quick background on the Federal Reserve. Again, if I take out that dollar that I used a video or two ago, bring it back over. Again, you'll notice at the very top, right up here, Federal Reserve note. So they're regulating our money. So the Federal Reserve, I mentioned this before, is the central bank for the United States. They are the chief enactor of what we call monetary policy. We have defined monetary policy very early in the semester, but I'll give you a definition again if you want it for your notebook right now. Monetary policy is any policy that affects aggregate output, employment, and or prices. Any policy that affects aggregate output, employment, and or prices, and is enacted by a nation's central banking authority. And any policy that impacts aggregate output, that just means GDP, employment and or prices, and is enacted by a nation's central banking authority. So again, we'd already defined that earlier this term, but I thought it might be a good idea to put it in now because our chief monetary policy body is the Federal Reserve, right? The central bank of the United States. The Federal Reserve was created in the 19-teens, if I have my date correct, 1918. Actually, as an initial, it was an act of Congress. We were talking earlier this semester about like the bank issues in the early 1900s. Congress saw a need for there to be some body that oversaw banking policy, that oversaw money supply, bank transactions, etc. So they created the Federal Reserve. The Federal Reserve is not a branch of government. It is not a branch of Congress. It is not part of the executive branch. It is meant to be wholly freestanding from those. So that way that there's not too much influence on the Federal Reserve to change the money supply, to appease the government, the lobbyists, whatever. That's not to say that there's not any oversight whatsoever. There is going to be some oversight as we kind of talk about the Federal Reserve and the tiers where both the executive branch and Congress have a small amount of oversight, but they don't have any control on Federal Reserve action. The Federal Reserve does operate as a bank. As we, again, learn a little bit about how it's doing its stuff. One of the things the Federal Reserve can do is make loans, just like other banks can. And if they make loans, they can make profit on those loans. They utilize that profit to keep the bank running. So the Federal Reserve does not receive money from Congress. They are required, they're responsible for their own operations. If they want to build new buildings, if they want to hire more employees, if they want to give raises, whatever, they are responsible for generating their own money. Any profit that is above their annualized budget is actually returned to the Department of the Treasury. That takes away the incentive for the Federal Reserve as the, being in charge of money and in charge of the banking sector to takes away the incentive to completely eliminate that banking sector and keep all the profit for themselves. They don't get to. They have to return it to the United States Treasury. So there is, again, a little bit of tie in terms of oversight there. So that's kind of a little bit of a brief history. In terms of the workings of the Federal Reserve, there are 3 tiers. So it's kind of arranged in a hierarchy and then geography later on. Our top tier is known as the Board of Governors. Board of Governors. So the Board of Governors are going to be the ones that are responsible for making all of the goals, the short and long-term goals of the Federal Reserve, as well as setting a lot of our rates. Again, air quote setting, deciding on that targeted interest rate to some extent. The Board of Governors has 7 members, and each member is appointed for a 14-year term. So it's a really good job security if you can get it. The Board of Governor members are nominated by the executive branch, so they're nominated by the president, and then they are confirmed by the Senate. So again, there is some government oversight there. The 14-year term comes into play because in theory, every 2 years, one would get replaced. So they kind of go on a rotating cycle. So that would be 7 years, if you will, or 7 different appointments going through a time period. It effectively is meant to kind of limit any influence any one president or one party in Congress has. So they kind of try to spread it out. So they're not all appointed at once, so that way it kind of avoids a political grouping, if you will. Again, after that initial appointment and authorization, they are not responsible for anything that the government desires. The Congress can't go to the Board of Governors and say, increase the money supply. They can say, no, we don't want to. Out of the Board of Governors, they appoint a chairman of the board or a chairwoman. Is our current one Janet Yellen? I think so. I think Janet Yellen is still our current chairwoman. And the chairwoman is kind of the de facto spokesman of the Fed. So they're going to go in front of Congress and give the report of what is the Federal Reserve doing and why. They're also going to be the mouthpiece that talks to the media. Other than that, they don't really, there's not a special role for the chairman. They don't get special ability to set anything because it does all have to be approved by the Board of Governors. So they're the ones who come onto the news and tell you what the target interest rate is. And they also do make public the goals of the Federal Reserve, both long and short term, so people can plan and know what kind of the idea going forward is. Below the Board of Governors, the next tier is the FOMC. I bet you a lot of you have heard that acronym, but maybe don't know what exactly that means. So the FOMC is the Federal Open Market Committee. This is what it stands for, Federal Open Market Committee. And the FOMC is going to be the group that is responsible for the buying and selling of government bonds. So like those treasury bonds and stuff, those are regulated by the FOMC. So all the Board of Governor members sit on the FOMC, as well as Federal Reserve Bank president, like district bank presidents are also on that FOMC. And we'll talk more about this buying and selling of government bonds here in just a few minutes or in a different class lecture. So they meet with they meet with a little bit more regularity, I think, in recent times. But their operations are actually daily operations. So they are going to be active in the bond market every day that the market is open. And that's going to be probably our chief kind of like short-term or really rapid monetary policy, where a lot of our other ones are more long-term kind of monetary policies. Finally, below the FOMC, we have our 12 district banks. These are arranged geographically across the country, which is kind of interesting in a couple of regards because it is based on the geography. It was based on population when the Federal Reserve was established in the 19-teens. So geographically, most of the banks are east of the Mississippi River. So they've never actually really changed that, even though population has, since the 19-teens, migrated significantly far west. We find that in the West Coast, there's one district bank that handles California, Oregon, Washington, Nevada, Arizona, that whole area, which encompasses millions and millions and millions of people. And then if you look and compare that in size to some of the district banks out east, there might be a district bank that encompasses, not even a whole state. So it's kind of interesting. They based it on population in the early 1900s, and they've never really revised it. Missouri is a unique state in that we have two district banks. We have a district bank right here in St. Louis. I believe our St. Louis is District 8, and there is a district bank in Kansas City as well. The St. Louis district encompasses the eastern half of Missouri, southern Illinois, the entire state of Arkansas, and then parts of Tennessee, Kentucky, and Mississippi. So kind of if you start in St. Louis and kind of draw, a circle, that kind of covers the St. Louis area. So what do our district banks do? So our district banks are going to do a couple of things. First of all, they're going to ensure that all banks within their district are following banking policies that are set by the Board of Governors. So they're going to make sure that all banks are following all the rules. They're also going to be the distributors of currency in that area. So if any banks need money, if they're running low on currency, now everyone has an electronic balance, but what if you need cash on hand? They can go and get it from the Federal Reserve. The Federal Reserve also allows these banks within their district to hold electronic balances in the Federal Reserve. So they act as a bank as well, and other banks can store their money there, whether that is electronically in digital age currency or whether it's actually in hard cash, hard currency. The Federal Reserve District Bank does have vaults accessible to that. Finally, the district banks act as what is known as the lender of last resort. Lender of last resort. So like I said, hey, they're still a bank. You can borrow money from them. But it is kind of meant to be a last resort. In fact, when I say you can borrow money from them, I'm phrasing that poorly, because you cannot go borrow money from them. They are not going to engage in transactions with individuals, and really not with even businesses. There I think is only one or two business exceptions, companies that might have national security ties where they're not making all of their information known to other banks. Really what this means is banks can transact with them. So that's something else that we're going to look at. All three of these tiers have the capability of changing money supply. Again, some of them on a more rapid basis, the FOMC, some of them on probably slower basis with the Board of Governors. So I think that's what we'll move into as we kind of go forward. Next class is we'll start looking at these policies, and then, you know, again, kind of like, well, you know, what are they doing to money supply? Okay, I think that's probably a good stopping point for today, and then we'll pick up.
Roll lights.